Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us at the MarketSite studio, we have Brian Joyce, Managing Director on Nasdaq's Market Intelligence Desk, for a review of first half 2023 performance in the Nasdaq-100. Brian, I mean, the performance was remarkable in the first half, but the key question is it real? How does it compare to the dot-com era, 2001 versus 2023? What are your charts telling you from a technical perspective?
Yeah, so we have a lot of naysayers out there, bears out there, and you can understand the skepticism with this marketplace. We have had narrow breadth throughout much of the year. We've seen the biggest gains by the biggest mega cap stocks. Breadth has been improving since June. I'm still very constructive on the broader markets. It's really just based on the price action. Certainly, higher rates have me, skeptical about, net interest margins for the financials and the slowing economy. But from a financial services point of view, from the financial markets, I should say, I think there's reasons to be optimistic. We saw a record first half for the Nasdaq 100 on an absolute basis, as well as relative to the Dow, the S&P, and the Russell 2000. If you go back to the top 10 prior years, when the Nasdaq most outperformed the S&P 500, the second half of those years has been very constructive. The Nasdaq 100 has averaged over 21% in the second half of those 10 years. S&P 500 and the Dow were up over 11% on average those years, and the Russell 2000 not as strong, but averaged I believe gains around 5% and higher most of those years. 8 of those 9 years were higher for almost all of those indices.
Well, I guess the key question is, does this feel like .com, right? Because that was really where the momentum was in 2001, and then 2023 we come in and everything's about AI. So is it peak hype cycle, or are there differences from a technical perspective?
Yeah, so we did see some very powerful bear market rallies in 2001. We saw gains of 45%, 55%. Let me come back here. So this is the daily period chart going back to 2001. We have the 50 and the 200-day moving averages there, and you can see we had a 3-month rally of 43%. We had about a 1-month rally of 52%. Each rolling over to new lows. We even went as high as 59% in late 2001. What's different this time around is if you look at the moving averages, the 50-day made a bearish crossover of the 200-day back in September of 2000. It never got back above that 200-day moving average till 2003, whereas we see right now we were almost 4 months into that 50-day crossing bullishly over the 200-day. So that's one very noticeable difference. I know we've been stalling out for the last few weeks, but we highlighted that at the time it was expected resistance. There was also a pretty meaningful spread between the price on the 15th, when we made that high in June, to the 50-day moving average. It was almost 12%. I went back and looked and said we haven't seen that since the early days of 09. And before that, we haven't seen price that much above its 50-day since the early days coming out of 2003 lows, 2002, 2003 lows. So early stages that early stage price action that you would see coming out of a bear market or a significant market decline.
Yeah, well, I mean, I guess you have to think about valuation here. You're going to have to be able to justify the multiples that we've run up since the beginning of this year. But, as we can see in today's price action, still very sensitive to what's happening with macro data and potential interest rate strategy shifts. I mean, the jobs data, nearly bested estimates by doubled.
Yeah, and I think the price action is noteworthy. The Nasdaq is doing this in the face of rising rates. We're still expecting 1 to 2 more rates. That's what the Fed's saying. The Fed, the bond market hasn't believed the Fed for so long, and the Fed has been dragging the bond market along higher with it. The jobs data, the economic data, the GDP data, the housing data. Housing data is very important for the for economic activity. So there's been a lot of reasons why you could say the market maybe the market is seeing things coming down the pipeline. Summarized simply by improved economic activity and employment data. The jobs data today was very strong at ADP. So we'll see how that is confirmed on Friday when we get the monthly payrolls data, but I would assume that it's looking very well. But even with today's very strong data, higher interest rates, the 2-year yield made a new high on an intraday basis at least, but we could see that the Nasdaq 100 pulled right back to the price gap that was reached on Friday and is now trading at the high of the session for today. So the price action is telling we are going higher in the face of higher interest rates, and we've certainly seen a lot of I would say, hawkish rhetoric in the recent weeks from policymakers within the Federal Reserve, including Chair Powell, and those long duration groups like the Nasdaq 100 are still holding up well in the face of that.
All right, Brian, appreciate the insight as always. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.